Hey everybody, it's Atheist for the Cause, and I wanted to do a quick video about the Fed's raising interest rates. So it says Fed raises rates despite Trump opposition. The Federal Reserve has raised interest rates again in spite of warnings from Donald Trump against the move. Officials at the U.S. Central Bank voted to lift the Fed's key interest rate by 0.25% to a target range of 2.25% to 2.5%. But they also said the future increases could come at a slower pace amid concerns about global growth. Um, See, we're still growing well in the United States, but around the world, they're not doing as well as we are. It comes after the U.S. president on Tuesday warned the Fed against making yet another mistake in raising rates, urging it instead to feel the market. And I don't know what the rate should be at. To be honest, I don't know. It's when you get into the details about how fast the rate should rise and all that kind of stuff. That's really difficult stuff that there's no clear answer to. Personally, if I had to decide, pick a side, I guess I would have liked to seen them pass on raising the rates around Christmas and see how the market plays out, going into next year. And then if you need to raise the rates, raise them next quarter. Uh, but at the same time, raising the rates now does project confidence in the market going forward. So um, he also urged the bank not to wind down a multi-billion-dollar stimulus program brought in after the financial crisis. Mr. Trump, who appointed the Fed's chairman Jerome Powell, has reportedly blamed the central bank for unsettled markets and dismissed analysts who cite other factors such as rising trade tariffs. But his remarks have put pressure on the Fed, as presidents generally avoid criticizing the bank publicly for fear of politicizing the institution. Um, Trump tweeted, "I hope the people over at the Fed will read today's Wall Street Journal editorial before they make yet another mistake. Also, don't let the market become any more illiquid than it already is. Stop with the 50 Bs. Feel the market, don't just buy meaningless numbers. Good luck." I think what Trump means by feel the market is, project how it's going to, you know, grow in the future instead of just um, judging the numbers and what they mean right now. So the ironic thing here is that Trump's actually arguing, you know, a lack of confidence in the economy, because if he doesn't think that our economies can take the hit from the raising in the interest rate, that's a lack of confidence. So the Feds are the ones who are projecting confidence in the economy here. At a press conference on Wednesday, Mr. Powell defended the Fed's independence, saying the political pressure played no role whatsoever in its discussions or decisions. He added that the Fed had no plans to change its ongoing reduction of its portfolio of treasuries and mortgage backed securities. Fewer hikes next year. The bank has been gradually raising the benchmark rate since 2015, moving the U.S. away from the ultra low rates put in place during the financial crisis to spur economic activity. I mean, yeah, back in the day, it was common to have interest rates of like 25%. Now we have, we don't want interest rates that high now, but we did have interest rates of 0% for a while. And the problem when you have 0% interest rates is when you hit a recession, there's nothing you can do to ease that recession. So you just have to take the full force of it. So when you are growing economically, you need to raise the rates to not only stop inflation or slow down inflation, but also to give yourself uh, a little space there so that you have interest rate to drop. Because the best thing a country can do to take the hit away from the recession, to take the pain away, is just lower the interest rates. That makes borrowing easy. Wednesday's decision, which was widely expected, marked the ninth increase since 2015 and the fourth this year. Now, I had previously read, and I think I did a video on it, that the feds were actually deciding only to do three hikes this year, but they did end up they wanted four hikes, then they went back to three. Now they're going back to four. So this is a sign that they were confident in the market. They became a little less confident, and now they're more confident at the end of the year again. So that's good news for the economy going forward. However, the moves have made borrowing more expensive, contributing to slowdowns in some sectors, such as housing. Well, that's the whole point of raising the whole point of raising interest rates is to slow down some of the growth. Because if you grow too fast, it creates inflation and causes bad problems. And with economic growth expected to slow, some worry that the further increases risk stifling economic activity. Yeah, that's the risk. If you do raise the interest rates and artificially lower your um, economic activity, then if you actually have slowed economic activity naturally, the two combined are not going to be a good combination. So if the natural economic growth is slowing down, you want to also slow down your artificial um, raise of the interest rates. On Wednesday, officials did cut their forecast for economic growth in 2019 to 2.3%, down from the 2.5% they anticipated in September. And estimates released by the bank showed most Fed members expected two rate increases in 2019, not three as previously forecast. But that doesn't mean a whole lot right now if they're saying two, because before they were saying four, then three, then four, like I said. So uh, we're gonna have to let this play out. Next year economically is likely not to be as good this year economically, but that's to be expected after 9 straight years of GDP growth. It follows a downturn in U.S. financial markets and concerns about slowing growth in the U.S. and abroad. However, Mr. Powell said the strength of the economy, which is expected to grow about 3% this year, still relatively good, justified another rate rise despite recent cross currents that have weakened the outlook. We think this move was appropriate for what is a very healthy economy, he said. Policy at the point does not need to be accommodative. See, if you look at the economic indicators, one of which the greatest is probably unemployment. Um, Unemployment was last I looked still at 3.7%. That was in November, so we'll see what December is at. But our unemployment's still really good. So if people have jobs, that means they're getting money. They're gonna spend that money, and you're gonna have a solid economy unless a bubble pops. Like I am most worried about the education bubble popping, but I think there's enough security behind that I don't think that's gonna pop as easily as many make it out to be, and I don't think the education bubble is gonna pop anytime soon. Well, I call it the education bubble, whatever you want to call it. Basically, the debt students have. The only thing I think what would pop that is like some sort of policy change. In its official statement, the Fed also said increases to its benchmark rate would help the U.S. economy sustain its expansion, keeping the unemployment rate low and inflation near 2%. Market reaction. Keep in mind that market reaction doesn't always mean what you might think it means, because um, like around Christmas time, we've lost something like 4,000 to 5,000 points in the Dow. A lot of that's because it's the end of the year and there are, people going on vacation, things like that, pulling their money out so they don't have to watch it. But also, um, around Christmas time is when You have fewer orders, like, you know, December and January are the two worst months for selling vehicles. So it is just a natural time for an economic downturn. So you have the market reacting to the time of year, but then you have the market also reacting to still tariffs and uncertainty like that. And 9 straight years of growth makes people nervous that we have a recession going, because I don't think we've ever grown that long without a recession. It's usually like 4 years to get some sort of mini recession. And yeah, so people are starting to what's called pricing in a recession. We're not there, we haven't hit that recession yet, but they expect it coming, so they start selling stocks trying to get ahead of the recession. And that makes the stock market tank, but the economy is still good. So those people could just lose money if the economy continues to do well. Shares sank after the announcement, reversing earlier gains. The Dow and S&P 500 closed about 1.5% lower, while the Nasdaq fell 2%. I think more than 2%, supposed to say. In Asia, Japan's benchmark Nikkei 225 was down 2.5% in early afternoon trade on Thursday, following Wall Street's lead. Hong Kong's Hang Seng Index and South Korea's KOSPI index were both down more than 1%, while Australia's S&P ASX 200 was down 0.85% in very late afternoon trade there. I'm going to be honest, I don't know anything about, or much of anything, I should say, about foreign markets. So take it for what you will. Analysts said investors might have been hoping for stronger signs from the Fed that it would raise rates more slowly in the future. The funny thing is, um, yeah, the market likes lower um, interest rate raises, but that's actually a sign of a lack of confidence. So it's kind of backwards. Given the stock market declines and negative international economic news, recognized in the statement, this still points to quite a bit of confidence at the Fed in the ability of the U.S. economy to withstand a few more rate hikes, said Brian Coulton, chief economist at Fitch Ratings. Like, I don't know, I think that eventually it'd be nice to get this. We're at 2.25% to 2.5% right now for interest rates. It'd be nice to get it up to probably like 5%, but that's probably not going to happen. So we'll see. I'm not an expert on this stuff, but just from watching it, for quite a few years, I've learned, and reading articles, I've learned quite a bit about this stuff. And, um, you know, people like to say the GDP isn't like a great indicator, unemployment's not a great indicator. It's like, yeah, none of these are perfect indicators, but stock market's not a perfect indicator, but all of them are good indicators. Like, you put them together to create a whole puzzle. That's why, when the stock market was doing good before, that's a good sign. Now it's doing bad. That's a sign of some volatility, and the people with money and skin in the game are pulling out, and that means they're not confident about the future. The Fed's raising fourth time their interest rates. That's an economic indicator that our economy is strong. Unemployment 3.7%. That's a strong indicator that we're doing well. So yeah, GDP. I don't have the GDP growth on me, but we're still growing pretty well. And so while that's not perfect, it's still another strong indicator. So, um, you don't want to throw all of these indicators out, because they all fit together to make one good puzzle. So, anyways, have a good one, guys. And I think, the news, if I would have to summarize this, I'd say the news on the US economy is positive. Globally, it's a little more negative.